Good morning, ARMR Insiders. Good morning, everybody who's in the ARMR universe. This is the ARMR Investing Way. Thank you for joining me this morning. I absolutely love you guys. We passed 15,000 subscribers on YouTube. So thank you very much for that show of support. And so on Wednesdays, I share this with all of you. We discuss, of course, the market, the ARMR Investing Way. We're going to go over our execution strategy, where we are in the spectrum of adding risk or taking risk off. We'll talk about our macro fund, focuses on the indexes. We'll talk about our ARMR Invest portfolio and how we build portfolios for capital that we manage. We call that ARMR Flagship. So I'm going to go over all that. Before I do, don't forget, I respectfully request when you join me to think of yourself as a portfolio manager on a hedge fund desk. It's a virtual hedge fund, okay? So this is our morning meeting to get ready. So grab a pen, piece of paper. You have to figure out your risk tolerance, what your goal is for your capital, and then execute that at the end of the day. All I can do is share with you information that I use to make money for myself and for my clients, to protect capital for myself and for the portfolios I manage. And then you take that and see how it works for you, okay? Only you can be the smart money of your own assets. So it took me a while to get to the desk today. I'm a little bit late to this morning meeting. And it was very hard for me to focus on the market and actually write the morning meeting notes, which I email to all ARMR Report subscribers. It's in your mailbox. ARMR Insiders. Not only do you get it to your mailbox, but you also see it in our Slack room. You can see what I'm thinking. It was very hard for me to have this conversation, I'll be honest with you. I titled this discussion today, Wednesday, November 5th. This is a day that's going to go down in history. I titled this discussion, "The Barbarians Are No Longer at the Gate. They're running the city." They're running the city. It's very disturbing. It's very disturbing. 24 years ago, over 3,000 of my fellow New Yorkers were murdered by Islamists. And they just completed their conquest 24 years later and took over the city. That's not fear-mongering. That's fact. If you think it's fear-mongering, I think you need to wake up. This is no longer an argument between Democrats and Republicans. We got to get together, guys. Democrats and Republicans got to get together and fight the common enemy, which is cloaked in socialist, communist, environmentalist costumes to get the uneducated, or worse, the self-hating, virtue-signaling, loving crowd, to give them power. That's what's just happened in what used to be the greatest city on earth. And that should be very disturbing to you. I don't care if you're a Democrat, Republican, we all need to come together. This is exactly what's happening on the streets of Manhattan. Wake up. We got to wake up and figure out what we're going to do about it. So it's very hard for me to come in here and have a discussion about the stock market when something vile and dangerous and disturbing is unfolding in the country. And people are still bickering about the old problems. Getting to the stock market. The risk monitor has been yellow for a while. It can't go green. That's always a sign of possible problems right underneath the surface. I've been saying to you, look, as long as it's yellow, I'll have capital to work. And in all, fairness, 2 days ago, our portfolios closed at the highs of the year. So we were making money in a risk monitor yellow. Yesterday, lost a little bit off the top. That's always going to happen. We're never going to top take the market. But we took yesterday's signal to raise a lot of cash on this desk. We went from 20% cash in the portfolio to 80%. When I say 80%, I call that cash and equivalents. So that's treasury bills, which is like around 65% of the portfolio, something like that, 68% of the portfolio. Physical gold and silver, and the utility stocks. That's a very defensive portfolio. And then we have about, 20% of our portfolio still committed to stocks that we're trading around the core that are in the growth part of our portfolio. That's a dramatic shift yesterday. Let me walk you through some chart patterns of why we're doing that. First of all, just as an aside, before we dive in there, top stock to sell, it was AMD yesterday. Sold it before the close, above 250, bought it for $1.5625 in an unbelievable irony. We bought it on 9/11. So we got long 9/11 at $156 and change, sold it $250, booked a huge gain, stepped out of the way of the earnings announcement. Stocks down about 2% on earnings. It was a struggle. I almost wanted to hold it in the earnings, but the fact of the matter is stocks are being sold on great earnings numbers. So the reward to risk. So let's start writing down things that are wrong with the market. The reward to risk is flipped on its head. Things are getting more risky than they are giving us a reward at this level in the market. Palantir blew out the number, raised guidance, stocks sold off. It first started here. This was another example. GEV, a really great earnings announcement, great story. I was looking to buy the stock in that green box. It never got there. Instead, it's breaking down. That's just a couple of examples. Let's keep going over charts, okay? There are 3 charts that are holding the market up of our risk monitor that keep the risk monitor yellow. The S&P weighted is still above its stop. The NASDAQ weighted is still above its stop. And the Dow is still above its stop. So the risk monitor is not going to be red if those 3 indexes continue in an uptrend and stay above their stops. What I want you to see here is this was risk monitor red day, okay? And then the risk monitor flipped back to yellow right here. So I don't know, we'll give it like a light green color, okay? So as long as we're above that big down day, market's in an uptrend, even if it comes down in here, it'll make a higher low. Okay, nothing wrong with that. Now look at the equally weighted S&P. That's a completely different picture. So what does that really tell you? The hateful 8 are holding up the market. Blowouts in Google and Amazon are holding up the market. Nvidia hitting new highs, but the rest of the market is putting on tops. Here are the small caps. They're about to break below the 50-day moving average if they continue lower. Here are the mid caps. Perfect double top. They look terrible. Now, here's the thing that really disturbs me. We already knew that. So that's why the risk monitor was yellow, not green. We saw lagging indexes in our risk monitor. But now what we've got are the leading indexes violating stops. This is the momentum index, been carrying the market all year. Below the 50-day moving average and closed below the low of the last Risk Monitor red day. And how about the IBD 50, which is one of my favorite indexes, the innovation, perfect double top reversal in a big way yesterday. Now let's go over to the canary in the coal mine. That's always been Bitcoin. We talked about this yesterday. It's worth talking about it again because it's so ugly. Going back to when Bitcoin, became an asset, a fully blown asset, right? Where there are 10 different ETFs collecting Bitcoin. There's futures, there's options. All of that happened back here. And so then we had these beautiful risk on signals. It's why Bitcoin's part of the risk monitor. Back in here, Bitcoin goes risk on green before the market back. That was November, right in front of the election. Then again in April, the market's cratering, and yet Bitcoin puts in a double bottom and breaks out. This helps us get to risk monitor green, and we just made a killing on that rally. Something is wrong with Bitcoin. Something's wrong with the risk on trade. So here's the S&P trading above the low of October 10th. Here's Bitcoin. This is the October 10th day. Straight down, making new lows, making lower lows, breaking below the 200-day moving average, and traded sub 99,000 last night. Right now it's trading at 102 and change. I share with you the micro strategy, or the strategy Bitcoin price. On average, 74,000 is around the price of that Bitcoin hoard, which comes in around 43 on IBIT. Okay. I submit to you, I don't know who is the greater fool that holds strategy stock. I don't know who it is. First of all, the chart pattern is god awful. It looks like it's about to implode. Second of all, it trades at 1.4 times the net asset value of the Bitcoin it holds. And it's the whipping boy of the rest of the capital structure at MicroStrategy. The total whipping boy. They just did another preferred stock deal. And if you read the fine print, in order to get money, in order to raise money for that preferred deal, right there in the fine print, it says, and hey, if we can't meet the dividend, we'll just sell more of this stock and pay you. How is that not a financial scheme? I don't get it. I mean, I guess it's honest because they're right out there telling you. We're going to screw the common shareholder constantly to pay the rest of the capital structure. And people still own it. I don't know. Crazy. So what we've got here is a market in a very, very dangerous situation. Risk monitor's not red yet, but if we get further downside into the week, the risk monitor will be red. We're already in a large cash position, so there won't be much for us to do. But if you want to search for the reasons why the market is selling off, and why, by the way, even the S&P and all the other indexes, every index is below the low of Fed day. That's here. So you might be asking yourself, what's the big deal? I mean, the Fed came out, cut rates, and the quantitative tightening's over December 1st. So isn't that supportive of the market? Now, we know the Fed said, hey, we don't know if we're going to cut rates in December. That may not happen. So the market sold off a little bit. What's the big deal? The Fed's adding liquidity. You can hear it. You can hear it underneath the surface. There's always cockroaches trying to get out in every market cycle. And liquidity is what keeps them down. And when you have a credit crisis brewing under the surface, you need more and more and more liquidity to grease those skids, or things go off the rails. Now, if you listened to the conference calls of major U.S. banks, JP Morgan being one of them, they highlighted a credit crunch that's going on with companies. This is the insurance index, okay? This is their insurance stocks. Huge pennant formation breakdown. JP Morgan highlighted the issues with non-depository financial institutions and private credit. Now listen to this. This is the facts of the case. They're undisputed. U.S. banks have lent over $1.2 trillion to non-depository financial institutions, that's like insurance companies, and private credit in 2025 alone. That's this year alone. It's an opaque market, not a lot of regulation. The FDIC has come out and said there's an issue here, and they're requesting more information from banks so they can figure out the interconnectivity of which banks are really at risk. Follow the bouncing ball, and you get to KRE, the regional banks. We already know the regional banks are putting in a perfect double top in the process of breaking down. I could have talked to you about this months ago. This doesn't happen overnight. It's been brewing. It has been brewing. Market's been going up. We've been making a lot of money on this desk. I don't talk about these things. When we're making money, markets are going up. We read and react to what we're seeing, and we commit capital. We don't worry about these things. You could fear monger about this all day long, all the time through a bull market, okay? So I don't talk about it. But when we start to see a series of events unfolding, we put the pieces together of the puzzle, we see a credit problem starting to rear its head. We see inversions in overnight lending rates in these institutions that clearly show a credit crisis is brewing. This is why the market's so sensitive to the Fed cutting rates. I think people don't really understand that. I think people are, well, Trump wants the Fed to cut rates because it'll help the stock market or whatever. That's respectfully, I don't think that has anything to do with why Trump and the rest of the administration wants the Fed to cut rates. It's because Trump and the rest of the administration are run by businessmen, and they see what's going on in credit, and they know that's a problem. And when the genie gets out of the bottle, it's harder to stuff back in the bottle. These things happen every cycle. 2008 was collateralized debt obligations. It was mortgage-backed securities. Underregulated, unregulated ways to package and hide credit problems and sell it to the public. It's just rinse and repeat. It's a whole new way of doing it. You go through another surge. Everyone's doing great. Markets up big. Liquidity, fantastic. And you start to get these opaque, dangerous credit situations. This is why the market's suffering. This is why it's important the Fed cut rates aggressively. If there's a misstep here, we have a credit crisis. So this is why, look, we've had a huge year on this desk. We've had a huge year. If I did nothing between now and the end of the year, we win. I mean, right? I mean, we win. I mean, I'm going to collect 4% in interest and treasury bills. I'm done. I could literally be done right now. I don't have to do anything between now and the end of the year. What would I do? Okay, let's look at this real quick. Once again, our most aggressive trading strategy, which is up over 184, call it 85% now. We're up over 185% in 36 months. I got to change that, okay? Trade 26 just ended. Trade 26 ended. We bought it in the green box, sold it in the pink box for a tiny gain. And I said to you then, I said, well, that's a really tight stop, but it tells us we need to be a little more defensive. when that strategy gets stopped out. There's a reason. Now we see the reason. So what will I be doing between now and the end of the year? I have core positions that I'm still holding, but we have large gains, okay? So I'm still long Micron. I'm still long SanDisk. We're up huge on these things, okay? I got some NVIDIA in the portfolio still, got IBM and Cisco in the portfolio, okay? So we're trading around the core of those positions. I would increase the size of those positions if the risk monitor goes green sometime between now and the end of the year, which may still happen. These stories I'm telling you about when it comes to the credit and all these issues, man, it's like a frog boiling, very much like our political system in the country right now. And quite frankly, in the West, right? It's like a frog boiling. 1 minute, everything's fine. Next thing you know, you're dead. So everything I'm talking to you about in the credit markets, the market could look past it. We're at the right time of year for the market to go up. November, December, market goes up. And these things could rear their ugly head in the first quarter of next year. So we read and react to this test, right? Bell's about to ring. Market's about to open. We'll be day trading the index. We'll be looking for the next swing trade following this unbelievably successful strategy. I think it's fair to say that, right? Up 185+% in 36 months now. And that's not back tested. You guys have done it with me. You've watched me do it. This is real. Okay. So when this strategy gives me a risk on entry point, I'll put money back to work. This one right here. In our portfolio, we'll probably put index capital to work. All I'm going to do from here to the end of the year is probably match index performance. I'll use leverage. I'll use 2 or 3 times index exposure. So I might get, 150% maxed index exposure in a portfolio. I'll trade around the core of the positions that we're carrying, but you won't see me adding anything new. If things get worse, there's only a couple areas where I'm considering adding something, right? And those are hedged positions. We have physical gold. I'd like to make that a bigger position. It's a core position that we're trading around. I'd like more physical silver. It's a core position that I'd like to begin trading around. And the utilities, okay? Duke, Dominion, Southern Company, and AEP. These are the stocks that I'd like to own in larger degree. We own them in the portfolio now. I could see us owning more. If the risk monitor turns red, those are the type of assets go up. Okay? And everything else right now is off the whiteboard. I should say they're on the whiteboard, but they're not on the top of the whiteboard. I'm not making any new investments between now and the end of the year. Indexes, positions we already own that we're trading around the core, and perhaps defensive positions. That's it for me. I look forward to talking to you guys again next week and every week on Wednesday. I open this up for everybody. If you got questions, throw them in the comment section. Oh, somebody threw out a question. Yeah, Mark, I totally agree with that. And good morning to you, Ivy. Nice to see you. Glad you could join. So, guys, if you want to, every Wednesday we do this. So I love seeing you guys on Wednesdays. If you have any thoughts or questions or trades that you think are, number one ideas we should take a look at, go ahead and dump them into the comment section, and I'd love to look them over with you. This is our day trading portfolio right here. This will be our focus today. So we're looking at trading the S&P. Those red lines are the key locations where we're looking to get a trade on. This is a 3-minute bar chart. Okay. Everything on here is an ARMR algorithm we call the price movement profiler, the PMP. Each bar is 3 minutes, blue up, red down. The colors are paint bar studies of buy triggers at key locations. The black dots are the VWAPs, Fibonacci extensions above and below, standard deviations above and below. That's how we trade. So if we get to a key location, I'll look to put a trade on the S&P. If we get to a key location. Otherwise, not really interested in trading aggressively today. Okay? Everybody, you're on your own now. I wish you nothing but success. I hope you guys take what I've said, think about it, and then figure out your own risk tolerance and goals and execute your strategy and be the smart one.